Welcome friends. In today's session, we'll discuss about bonds. But before that, let me thank all of you from bottom of my heart. I have crossed one milestone, which is of 100 subscribers. So please accept my deepest gratitude for that. So coming back to the topic. So investment is a fun when you know it. When you know what drives it, what are the things that I should look for, I should care for, and then it becomes easy. For example, we know that if the stock market rises, value of my equity portfolio will also rise, right? And this was primarily the reason why SIPs in mutual funds, retail investors have put almost 90% of their money in equities and just 10% in the fixed income security. But this 10% which goes into bonds is actually a very big market. So to compare it, let me call it the Bada Beta of house, right? The elder brother of the two investment siblings. Where the elder brother, why I call elder brother? Because it grows steadily, quietly, without pomp and show. So the today's topic is about bonds. So at the end of this session, what you should expect is that you are quite familiar with the nuances of investing in bond or fixed income securities. I know this session is a bit lengthier. I could have cut it down, but that would have been injustice to tell you the complete picture or to give you the complete picture. It would have been quite insufficient or shallow explanation in that sense. You can view it in one tranche, you can view it in two tranches. If you don't understand, you should relook at it. Drop me questions if you have any, even after watching this. So I'm all there with you. So let us begin. We will discuss 6 points which are important to know to understand bonds better. They are: why to invest, what are the key risks, what are the options available, what are the different types, how to pick a right bond or funds, and why now. So first thing first, what is bond? To understand bond, we first need to understand what fixed income securities are. Fixed income securities, as the name suggests, is any investment which promises you to return your investment with interest after a certain period. Right? This sounds very familiar. This is your bank's fixed deposit, right? And we know all about bank's fixed deposit since our grandparents' days. Then what is this beast called bonds? Whether you call it bonds, bond funds, debt funds, debentures, fixed income securities, they all are synonymous and are used interchangeably. The only difference they have with our bank's fixed deposit is that these instruments are widely traded, and that is what makes them a favorite investment vehicle. You can see from this table that bonds dominate both globally and in India. Even if not directly, indirectly, all of us are investing in these securities because the money that we put in either banks or insurance companies or retirement funds, they in turn invest in them. So any institution which offers us assured returns or benefits, which are like PF, insurance, retirement funds, and in some case, and in case banks, they necessarily invest, if not all, a large chunk into these securities. Now there must be some reason for this, right? So let's begin with the first question: why to invest in bonds? Actually, the reasons are very simple. Bonds or these debt funds are closest to banks' fixed deposit and should be seen accordingly as a formidable alternative. It provides predictable return, capital protection, besides locking your return over a longer period. And these are good enough reason for large institutions to depend on these securities. Over the last 5 years, the blue line shows the growth of bond fund versus the red line of Sensex, and you can see that the Bada Bhai quietly moves on. Today, we have another advantage to invest in bonds. Post SEBI guidelines, now we have clear demarcated funds to choose for every need, from overnight to really long term. That too with a mix of both corporate, government bonds, or independently. So, not knowing about bonds and therefore putting large chunk of money in equities only may impact the retirement fund corpus. But investing in bonds is all about understanding risks first. Without this, venturing into bonds can even be detrimental. There are four key risks, and since it's a traded security, biggest of all is the price risk. We shall spend extra time to understand this price risk. It is fairly easy to understand other risks, which are like default in terms of commitment of either interest or principal or both by the issuer, reinvestment of these intermittent cash flows to earn similar returns, and since it is a traded instrument, enough volume is needed both to sell and to get the right price. Price risk is nothing but change in price of bond which can adversely impact my portfolio value. To understand the price risk, we need to know how a bond is priced first and what are the factors which impact it and to what extent. Let's understand this with the help of this chart. So let us assume we invest rupees 100 in a bond which gives an interest of 8% every year, so 8% per annum, which is also known as coupon, for 10 years, which basically means I earn 8 rupees every year for 9 years, and in the 10th year I get rupees 108, which includes 8 rupees of interest and 100 rupees of my principal. So this is how the cash flow would look like. But we also know that value of 1 rupee in 2021 is less than the value of 1 rupee in 2020, right? Class 5 of concept of interest, remember? So we try to find out what is the present value of all these cash flows. This is also known as the discounted cash flow or time value of money. And we get this by simply dividing the cash flow by 1 plus r to the power n. And finally, the sum of all the present values is our price, which I am willing to pay for this bond. Now, this slide is very interesting. This slide alone can give you all the answers on bond, right? Since price is sum of present value of each cash flow, we know now that the price is dependent on A, the cash flows, which in turn is based on the coupon rate, B, tenor of the bond, that is the time period for which it exists, and C, the discount rate, which is nothing but the prevailing interest rate which market is willing to give for this bond. So basically, we need to ensure that cash flows are intact and discount rate is favorable. If any of these changes, it would impact price of my bond. So what do you think what will happen if I change R? Since R is in denominator, when R goes up, price will go down, right? So let's see how it changes. When interest rate changes from 8% to 9%, we can see that the price drops from 100 to 93.6. Likewise, when it changes from 8% to 7%, 1% lower, price moves up from 100 to 107. So nearly 7% on each side. It is clearer from this table. With a change of 1% in interest rate, the price changes by nearly 7% in opposite direction. Please remember, whenever there is a change of 1% in interest rate, the price changes in opposite direction. So incidentally, duration of this bond is also 7.25 years. Now remember, the bond had a maturity of 10 years. The total time period for the bond was 10 years, but there is something called duration, which is 7.5 years. So the bond of 10-year maturity of 8% coupon, 8% interest rate. But because of the present value phenomena, nearly 50% of money is recovered by 7.25 years. And this is called duration. The duration plays a very significant role in determining the extent of price movement with respect to change in interest rate, which is basically what is the price sensitivity with change of interest rate. So as a bond holder, I need to know what is the duration of the bond, or if it is a portfolio, the duration of portfolio of bonds. So this gives me an idea how much price risk I am carrying for any change in interest rate. So obviously if interest rate goes up, price of my bond will go down, and it will go down to the extent of the duration. So since duration is a significant part of bonds, let me spend some more time to explain some quick facts about it. So the duration, despite it being expressed in years and the English meaning which denotes time, it is a measure of price sensitivity with respect to interest rate. Also, it is only an approximation because it's a curved in nature and not a straight line. Exact price change gives a positive surprise to me. Actually, the actual price rise with or price decline, in both cases I am positively surprised. So what I mean is the actual price rise is higher than what the duration calculates, and likewise actual price decline is lower than what the duration calculates. So I am actually in for surprise, positive surprise on both sides. Also, duration itself undergoes a change, and it undergoes change continuously. And the reason is quite simple. Time to maturity changes every day. Interest rate also changes every day. So likewise, in a portfolio, trading of bond result into adding new bonds, exiting some old bonds. That also results into portfolio duration changes. So your price risk changes continuously. As an investor, we have to check bonds duration the way we follow P multiple in case of shares. Since it is established that interest rate is one of the major components in deciding price of a bond, we need to understand how interest rate itself to be looked at. So let me show you, this is a chart of Government of India bonds yield curve. This denotes what is the interest rate for various default free Government of India securities over different time horizons. This yield curve sets the tone for all other kinds of bonds in the market available for trade. So as expected, it's a normal upward sloping curve. So more the time to maturity, more uncertainty in price, more is the expected return, and hence more is the interest rate which I am expecting. So in fact, this chart, if you talk to any bond market expert, they will actually remember it by heart. Yield curve itself undergoes change. So between April 2016 and now, due to the general downward trend in interest rates, yield curve has shifted downwards by nearly 75 basis points or 0.75%, which basically means for a 6-year duration bond, 6 year multiplied by 0.75, that is 4%, but in opposite direction. So decline of 0.75%, gain of price of 4%. So if the interest rate is so important, the next natural question comes is how interest rates are set. What is the easiest way to track it? So on the left hand side, you can see the movement of 10-year Government of India securities over the last 20 years. Right? It securely moved one way, downwards between 2001 and 2003. Again, we saw a sharp fall during the financial crisis of 2008, and recently since the NBFC crisis started in August 2018. On the right hand side, I have shown RBI's repo rate over the similar period. I'm sure you must have heard about repo rate. It comes every time RBI announces interest rate in the economy. So they look quite similar, aren't they? So to make it even clearer, let me superimpose one over the other. So as they say, proof of pudding is in eating. You can see how correlated they are, actually nearly perfect. So we can surely conclude that RBI's monetary policy and its setting of repo rates sets the direction as well as quantum of shift in general interest rate in the economy. But even after that, RBI is often criticized that it is lagging in terms of managing the interest rates. Let me also show you how bond prices have reacted due to interest rate movement over the last 4 years. So you can see from the chart, longer the duration, higher is the fluctuation. Now there is a significant negative price impact on credit risk funds, which is due to default risk, which we shall discuss later. But otherwise, the longer the duration, higher is the fluctuation. So to conclude on price risk, we just need to know the duration of bond or the portfolio along with the general interest rate in the economy. The second most important risk is default risk. Since everything depends on the cash flow, if the cash flow itself is not coming, then we are in serious trouble. So the role of the fund manager, therefore, is to find out what is the probability of such defaults and whether it is priced accordingly. So this is where role of credit rating agencies become important. They analyze and suggest what rating should be assigned to each bond paper. Now obviously, better the rating, lower will be the cost to the issuer. But as the rating declines, investors would also demand more returns, more yields. So sometimes rating change even during the course of the bond. Here also the price accommodates itself according to the new rating. This chart will give you a clear idea on the default risk. So if you notice, bonds with lower rating have higher yields. Now here the green bubbles are the AAA rated, which is the best rated. So most secured ones you can say. So the extra yield on lower rated bonds is basically to compensate for the extra risk taken by the investor. While we may want extra yield or return, but we also have to strike right balance. So like penny stocks, bond also have something called junk bonds, which offer very high returns, but then the default risk is equally very high. So when we are choosing, we have to select the right balance. The third key risk is of reinvestment. Now if you recollect, coupons are paid on a regular interval, right? So since coupons are paid periodically and that too in future, we do not know if we could reinvest these cash flows into the similar yielding assets. Since the mutual fund receives such cash flows or any asset manager receives such cash flows, they have tough task to invest in similar yielding assets to maintain their returns. And sometimes if not managed properly, glut of cash flows causes overbidding and compromising on yields. Likewise, sometimes bond itself come with options to call back by the issuer. Now the issuer will call back when the odds are against the investor. So there is a double whammy for the investor. Now obviously such options are already priced in the bond yield, but nevertheless finding suitable investment opportunities is a constant challenge for any asset manager. So let me explain this more clearly with an example. So you can see in this table, 10-year yield is 6.93%, 20-year is 7.03%. So now this actually means the interest rate between 10th to 20th year is 7.13%. Now imagine at the end of 10th year, if the yield curve has shifted downwards, getting a 7.13% return for same risk would be unimaginable, right? Which otherwise I have already logged for 20 years at 7.03%. I am sure this table tells you the real challenge of reinvestments, right? We all are facing it in our bank's fixed deposit when the interest rates are going down. The last major key risk is liquidity. Now, not all bonds trade so easily or so equally. Sometimes they fell out of favor and do not trade for much longer period. So finding price for such bonds is only an estimate, or it is going to be difficult. So when the fund manager actually goes to sell, the buyer also asks for heavy discount in price. Sometimes the market itself is very illiquid. So many countries, including India, so the bond market's liquidity is low, and this overall impacts the price discovery mechanism. So while the government of India's bond market is fairly liquid, the corporate bond market is not so liquid, and that is where the price discovery mechanism may actually get impacted at times. Once you know the key risks, rest everything is quite simple. We have spent maximum time in understanding risk, but actually, if you just remember that you need to protect your cash flows with duration of bond, you don't need much things to worry about. So rest of the topics are quite straightforward, which we will cover in quick succession. So what are the options available to us to invest in bond market or bond funds? For the retail investors, today mutual fund and ETF offers the best route. Typically for a tax-free bond, retail investors also buys it directly from issuer. The behavior and mindset is exactly like a bank's fixed deposit with tax-free component attached to it. However, given the flexibility offered in terms of mix and matches by the mutual funds makes it the most suitable choice. The domestic mutual funds offer variety of solutions. I mean, for each kind of needs, right from overnight funds to long-term gilt funds and corporate bond funds, and with varying degree of risk and returns too. Another important thing one has to know is what are the different types of bonds available in the market. So basically, who is the issuer? What is its credit rating? What are the features like coupon rate, maturity date, frequency of coupon payment, any options which is attached to it, right? The way we have different type of shares available from large cap to penny stocks, from automobile to zirconium, from value to growth, and many more cuts. Bonds also have a spectrum comprised of bonds from all weathers. So this table shows some of those different issuers, but anyway, you have already seen these bonds of different combinations earlier. So now the moot question is how to select right bonds or bond funds for my portfolio. So the most important thing is my own need in terms of risk and time frame, for which my inquiry would be about yield, duration, and then obviously I would look for risk management practices of the asset manager, and lastly the expenses if any. So while the historical return is important, but that cannot be my guiding post and has to be best estimated by YTM, that is yield till maturity. So the last points, why talk about bonds now? Actually, bond is an all-weather friend. Remember, the shy, quiet, slow but steady moving elder brother of investments. So it is more important when uncertainty is high. The once in a century pandemic has raised uncertainty of all other asset classes. While equity market is at near peak, bond is needed to protect your wealth and capital. And most importantly, your asset allocation has to be looked accordingly. I don't want to add too much fuss on why now, but let me tell you that bond gives stability to your portfolio. Sit with your advisor, have a discussion around your asset allocation, see if you are carrying unnecessary risk, right? So with this, we conclude this session. I know it was a bit long one, but there was no point in giving you a shallow or incomplete overview. I hope this was worth your time. If you still have some questions, please put it in the comment box and I will definitely reply to it. I sincerely believe that this session is quite helpful to all of you. So till the next session, stay safe, stay healthy. Namaskar.